What's up, man? Matt Garland here, NMLS number 58700, better known as MG the Mortgage Guy. So look, my guys Envy and Caesar, they put out a video the other day and they broke down from an investor standpoint, purchase price, potential rehab, plus the ARV. The purpose of my video is to run the numbers for you guys at home. If you're a first-time home buyer, or maybe you're someone who's looking to buy a new primary residence and you don't want to buy at the retail level, but you don't know how you can finance your rehab. That's the purpose of this video today, to run the numbers for you guys. So if you're not familiar with the video I'm speaking about, watch this quick clip and then watch this video to the end, because I'm going to break down everything that you need to know.
Talk about this house a little bit. This house is 4 bedrooms.
4 bedrooms, 3,000 square feet, 3 bathrooms. Doesn't need too much. The only thing that I really see that I would definitely renovate right away would be the kitchen.
Okay.
You talk about you probably pick this up for $250,000 for a Bergen County, great school system, a lot of good restaurants. You pretty much have everything in this town.
It's pretty big. Check this out. I can run down my home. And I can come back this way. It's pretty big. I didn't go front. This is a good crib to, we got a family member we would keep indefinitely as a kid. This is one of those home runs. So now this house is probably going for how much?
Probably picking up for about $250,000, $275,000. You're probably looking at about $475,000, $500,000.
Okay.
Right, so then, this doesn't really need too much. As you can see, you keep the original floors. The walls are in great condition. The sheetrock is not plastered. Pretty much kitchen, bathroom. You probably put about $40,000 into it. Walk away with a quick $175.
Now you saw the video, right? Now let's break down the numbers. Let's run the numbers. So the loan that we're going to discuss today is a Fannie Mae Homestyle renovation loan. This is perfect for this type of project because you have a huge ARV. Remember, the purchase price is $250,000. You got about 40 to 50K worth of rehab estimated, and the ARV is $475,000 to $500,000. So I would not do a FHA 203K with this type of loan. We're going to go conventional with this one. All right. So you got your purchase price $250,000. All right. Now we have the rehab. Now Caesar said $40,000 to $50,000, but I'm going to tell you, let's just use $50,000 as a worst case scenario. In this business, you always want to use worst case scenario numbers. All right. Now with the Fannie Mae Homestyle loan, it requires us, the lender, to collect a 10% minimum contingency reserve just in case of emergencies. So if we got $50,000 in rehab, then a 10% on that number is $5,000. So that's why you see here, I have $55,000 rehab plus your 10% of reserves. So now that gives you a total of $305,000. Now that's what your down payment is going to be based off of, is that 305 number. So all you have to do to figure out how much you need for a down payment is 305 times, 5% times 305, and that gives you $15,250 for your down payment. Now, I'm basing this scenario if you have a 700 credit score or higher. If you don't have a 700 credit score, if you have a lower credit score, these numbers are subject to change. All right? So you're financing $289,750. Today's rate as of December 1st for a Fannie Mae Homestyle, if I was to lock you in today with a 700 FICO, you'll be looking at a 4.5% and an APR of 5.9%. Now, some of you may say, oh, 4.5%, that's a higher interest rate. Well, you have to understand, when you're doing rehab loans, FHA 203K or Fannie Mae Homestyle, they're going to be a little bit higher than what a normal traditional FHA or conventional loan would be. Typically, it's around a half a point higher, give or take, depending on your credit score, but that's just what it is because it's more of a risk to the lender. So they charge you a little bit of higher rate, but let's face it, 4.5% for a 30-year fix with rehab money, that's a lot cheaper than using a credit card, right? So your principal and interest payment, $1,468. Now your principal and interest is what you're paying back to the bank. Your monthly property taxes on that particular property is $10,000, so that's $833 a month. Your homeowner's insurance is $1,200 a year, so we collect $100 a month for that, and your PMI is $177. So your pity payment, which is your principal, interest, and taxes, insurance, that's your full mortgage payment, is $25.78 a month. All right, so $25.78 a month for this particular property. Now, some of you out there have a lot of student loans, car loans, credit card debt. So now let's talk about what income you would need to qualify for this particular property. Now, I'm using hypothetical numbers. This is not a real scenario. This is just me giving you a visual so that way you guys at home can kind of get a better understanding of how to figure out your debt to income ratio on your own. So let's just say you have a car loan, you have credit cards, you have student loans, and that comes up to $1,000 a month, right? Now, in your DTI calculation, a lender will never include if you have to pay for child care, what your food expenses are, your cell phone bill, your utilities. Those are things that we don't consider into your debt to income ratio, but you need to consider that when you're looking at any property, all right? So now your total debt is $35.78 a month. So how did I get that number? I added up your mortgage payment, which is $25.78, plus that monthly minimum payments that's reported on your credit report. That gives me $35.78. Now, your income, if you are in this scenario, you will need to have $95,000 salary. Now, if you're self-employed, if you get bonuses, if you got commission income, that's a whole different topic. I would need to review your finances to determine if you would qualify, but I'm just using generic numbers here, guys, so that way you have an understanding of how to calculate this stuff. So this is a salary of $95,000. No overtime, no commission, no bonuses, no nothing, right? A plain salary. So we use the gross monthly income to help you to qualify you on a loan. We don't use the net income. No lender uses your net income, but you need to look at your net income because you pay your bills off of the net, not your gross. Remember that, all right? So your $79.16 is your gross income. So now to figure out your back end ratio, because there's a front end and there's a back end. To figure out the back end, all you have to do is add up your mortgage payment plus that minimum debt on your credit report, which is $35.78. Divide that by $79.16, which is your monthly gross income. That's going to give you a back end of 45%. Now for this program, that qualifies. Now your front end ratio, which a lot of people don't talk about, right? Your front end ratio is just as important. Now your front end ratio, how you figure that out is your monthly mortgage payment divided by your gross income, and that comes up to 33. So your total debt to income ratio, the total debt to income ratio is 33/45%. Now per the guidelines, this would qualify, all right? But I'm telling you guys at home, you need to speak to a lender, you need to get yourself pre-approved because everyone's situation is different, all right? So please, before you go out and look at homes, speak to a lender, your mortgage guy, your mortgage girl to make sure that you can qualify for whatever you're looking at. Now, let's talk about your total cash to close because we often only talk about how much you need for a down payment, but that's not all you need. There's a such thing called closing costs. Now, I'm just using a round number for these purposes. You have to get a loan estimate from your lender to see the itemized breakdown of your costs. But for this purposes, I'm just going to use a 5%, all right? Which is a worst case scenario because this is a rehab loan. So if you're 5% closing and a 5% down payment, your total cash to close for this transaction will be $31,000, all right? Now, some of you at home may not have $31,000 saved up. Conventional allows you for the seller to contribute 3% towards your closing costs, right? So 3% on 305 will be about $9,000, right? You can also get a down payment assistance grant. You can get a down payment assistance from a lender. You can get a closing cost grant. There's many options out there. You can get a gift. So if you don't have $31,000 saved up, look into these options. Google down payment assistance, Google home buying grants, closing cost grants in your county or your state, and I guarantee you, you guys will see tons of information that will come up there. And if you're making a certain amount of money, you could qualify for those programs. Now, a lot of them have income restrictions, and that's why I'm telling you, you have to do your research, all right? So this is just a quick scenario, just giving you guys the inside play on how you would finance a property that Envy and Caesar was just in. And you as a first-time home buyer, you got to think about this, right? If you're a first-time home buyer, if you're only financing $289,000 and that house is worth $475 to $500, think about how much money you just made, right? In equity. Equity is monopoly money. It's not real until you touch it. So just remember, in order for you to get that money, you would have to probably take out a home equity line of credit or flip the house like they was discussing. But it's better than buying at the top of the market from the flipper and buying it for 475 and 450. You have no room to grow. Having our last seminar, December 15th at the Jacob Javits Center. If you want to learn more about real estate, I encourage everyone. This is a perfect holiday gift. Make sure you're here December 15th at the Jacob Javits Center here in New York City. Click the link in my bio for more information. If you have any questions, click book in my bio for a free consultation. Happy holidays, everyone.